Hey everyone, welcome back to Corporate Decoder. Today, KHC Kraft Heinz Company just filed its annual report on Form 11K, and I am seeing some interesting trends in their employee savings plan. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company's employee savings plan is showing growth in its investments, but let's look at the details to see what that really means for the company and its employees. This is the Kraft Heinz Savings Plan annual report for the year ending the 31st of December 2025. It tells us how the company's employee retirement savings plan is doing financially. Think of it as a peek into how the retirement nest eggs of Kraft Heinz employees are invested and managed. First up, we have the auditor's report. The Auditors Crowe LLP say the financial statements are a fair representation of the plan's financial health. They've been the plan's auditor since 2017, which is good to know. They checked the financial statements and a supplementary schedule of assets. Everything seems to be in order according to them. Now let's dive into the numbers themselves. This is where we see how much money is available for benefits. Basically the total value of the employee's retirement savings. As of the 31st of December 2025, the total net assets available for benefits were a little over $3.9 billion. That is up from about $3.6 billion at the end of 2024. A huge chunk of this, over $3.6 billion, is invested in something called a master trust. This is where the plan's assets are pooled with other company plans for investment purposes. The auditors say this investment is valued at fair value. For the end of 2025, this important part of the investment was worth $3,647,831,000. That is a significant increase from $3,378,005,000 the year before. There is another portion, about $207 million in 2025, that is held at contract value. This typically refers to investments like guaranteed insurance contracts which are valued differently. We also see about $34.5 million in notes receivable from participants. These are essentially loans that employees have taken out from their retirement accounts, which is pretty common in these types of plans. Looking at how the net assets changed during 2025, total additions to the plan's assets were over $709 million. A big part of that addition, about $498 million, comes from the net appreciation from the master trust. This means the investments within that master trust grew in value significantly during the year. Employees themselves contributed about $99.5 million to their accounts. Kraft Heinz also chipped in with $71.8 million in employer contributions. On the flip side, employees took out or received distributions of about $443.8 million. So, while the plan is growing, there is also a lot of money moving out, which is typical as people retire or change jobs. Overall, the net assets of the plan increased by about $264.8 million in 2025. This is a positive sign, showing the plan grew despite the withdrawals. Let's understand a bit more about the plan itself. The Kraft Heinz Savings Plan is a defined contribution plan. This means employees and the company contribute to individual accounts, and the final retirement amount depends on how much was contributed and how well the investments performed. It covers eligible salaried and non-union hourly employees. Interestingly, the Kraft Heinz stock fund was frozen to new investments back in April 2022. This means employees can no longer contribute new money or transfer balances into a fund specifically holding Kraft Heinz stock. This is a significant detail, suggesting the company might be steering employees away from such concentrated investments. As mentioned, the plan's assets are co-invested in a master trust with other Kraft Heinz defined contribution plans, like the Savings Plan for Puerto Rico employees and the Kraft Heinz Union Savings Plan. Fidelity Management Trust Company is the trustee for this master trust. Employees can contribute in various ways, including tax-deferred, after-tax, and Roth 401 contributions. For 2025, the limits for these contributions were pretty standard, $23,500, with a catch-up amount of $31,000 for those over age 50. A key feature is automatic enrollment. Eligible employees are automatically enrolled with a 6% tax-deferred contribution unless they opt out. And their contribution rate automatically increases by 1% each year up to 10% unless they decide otherwise. This is a great feature to encourage consistent saving. Kraft Heinz offers a matching contribution. They'll match dollar for dollar up to 2% of eligible pay, and then 50 cents for every dollar between 2 and 6% of pay, leading to a maximum match of 4%. On top of that, there is a non-elective contribution of 3% of eligible pay for this non-elective contribution. Employees generally need to be employed on the last day of the year, with some exceptions for terminations due to specific reasons like disability or job elimination. If an employee leaves the company and their employer contributions aren't fully vested, those amounts can be forfeited. These forfeitures can then be used by the company to offset future contributions or pay for certain expenses. We saw this number earlier. Employees can take loans from their accounts. The rules seem standard, a minimum of $1,000 and a maximum of 50% of their vested account balance, or $50,000 whichever is less. Interest rates vary, and there is a $50 loan processing fee. Let's look at the master trust details. This table shows how the assets are broken down. As of the 31st of December 2025, the master trust held over $4.1 billion in total investments. The Kraft Heinz Savings Plan's interest in this master trust was about $3.85 billion. A portion of this, $207.3 million for the plan's interest, is in synthetic investment contracts. These are essentially insurance-like products that provide a guaranteed return. The company notes that the contract value is used for these because it is what participants would receive if they made a withdrawal. The largest portion, over $3.5 billion for the plan's interest, is in collective trusts. These are essentially funds that pool money from multiple investors to invest in a diversified portfolio managed by professional firms. There is also about $54 million invested in common stocks within the master trust that belongs to the plan. This is a smaller portion, and notably, it does not include new investments in Kraft Heinz stock itself due to the fund freeze. This section explains how the investments are valued. Investments generally follow a hierarchy, with level 1 being the most reliable, like stocks traded on major exchanges, and level 3 being the least reliable, based on unobservable inputs. The plan's investments in registered investment companies like mutual funds are valued at level 1, meaning they're based on quoted prices in active markets. Similarly, common stocks are valued at level 1, using closing prices on the last trading day. A large chunk of the plan's investments, over $3.8 billion in 2025, are in collective trusts. These are reported at net asset value, which is a practical way to value them since they represent a pool of underlying assets. Finally, let's look at the schedule of assets. This shows what the plan holds at the end of the year. The most prominent item here is participant loans, totaling $32.2 million. These loans have interest rates ranging from 3.25% to 9.50% and maturity dates extending through October 2040. The cost information is not required for these participant-directed investments, which makes sense since they are essentially loans from an individual's own account. So, what does all this mean? The Kraft Heinz savings plan appears to be in solid shape, with total assets growing healthily. The significant increase in the master trust value, especially the net appreciation, is a strong positive indicator. The automatic enrollment and escalation features are good for employee savings habits. However, the freezing of the Kraft Heinz stock fund is a noteworthy strategic move, potentially indicating management's desire to reduce company-specific risk for employees' retirement savings. While participant loans are a common feature, it is always worth watching if they become too prevalent, as that can signal financial strain for employees. Overall, the plan seems well managed and growing. The main story here is the overall growth and the strategic decision to limit exposure to the company's own stock within the retirement plan, which is a prudent move for diversifying employee retirement assets. Alright, that is my take. Stay decoded. If you want the broker and charting tools I use, they are linked in the description below to support the channel. Like this video if you found it valuable, subscribe for more, and join our Discord for ongoing discussions.